Hey everybody, good to be here today. My name is Brent Moores, sitting in for Mike Fairborn on ThinkScript today. Mike's going to be back next week. I know he's been gone a few weeks, but I think he'll be back next week at least. But I'm glad to have you today. I'm also glad to be joined by Kevin Horner helping me out in the chat. So between Kevin and I, will do our best to help you out. And as you have questions, if you're watching live, if you're not watching live, that's okay too. See some familiar names in the chat. Glad to have you guys all here. And just a reminder, you can follow Kevin or myself on X at Brent Moores CS, at Kevin Horner CS for additional content throughout the week. You know, I've worked with Kevin for a while now, and just a reminder, you know, for those of you who like to start off the day and are interested in trading, Mondays, Wednesdays, Thursdays, Fridays, we have trader talks in the mornings. That's at 9, starts at 9:30 Eastern time. It's a good way to start your day. Check that out. Kevin is on each of those days. I joined him on Wednesdays, but it's a good way to start your day every day. Now, I want to talk about a subject today that I think is applicable to everybody, certainly options traders. So we are going to talk about options today, but other people too. Okay, so and that's implied volatility, because I have a script that was shared with me by one of our viewers who we appreciate. And he gave me permission to share it with the rest of you. So I'm going to do that regarding implied volatility, and that may help you out. Now, if you're thinking, well, implied volatility is just for options traders, it's not. And I'll tell you why in a minute. Let me first go to these disclosures here. Equity and index options carry a high level of risk and are not suitable for all investors. Certainly, certain requirements must be met to trade options through Schwab. Multiple leg option strategies will involve multiple commissions. Okay, so just make sure you know your options, educate yourself in options. And we have several webcasts there and a course in options as well to try and help you learn options. But the information today is presented for general informational purposes only. It's not an individual recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as the sole means of investment research. The paper money software application is provided for educational purposes only. For the sake of simplicity, I may not factor in commissions if we look at sample trades here. Past performance of any security or strategy does not guarantee future results or success. There we go. Okay, let's head on over to the Thinkorswim platform. And I said I wanted to talk about implied volatility and a script on implied volatility, but before we even get to that, I want to talk about implied volatility because some of you don't know what implied volatility is. Implied volatility is essentially a measure of options prices. And what drives option prices? Options prices are more expensive if people expect more movement out of the stock in the option. Okay, so higher implied volatilities means traders expect more movement out of that stock, out of the underlying stock in the option. Okay, so there you go. That's why it applies. It is applicable to both stock traders and option traders. Now, there's more depth in the option trading stuff we'll get to in a minute. Well, in several minutes, we will get there. But right now, I want to talk about the movement in the stock. You can add just a standard implied volatility measure here. This is just a standard study under your studies, if you'd like. And you can see what implied volatility is. What does this mean? How do we do this? This is essentially an annualized expectation of movement on whatever stock we're looking at. This is just an example stock. Sorry, some old drawings there. This is just an example stock we're looking at here, right? Colgate. Implied volatility right now is about 27 on that. Okay, so this is an average implied volatility. Different options have their own volatilities. That's just an average implied volatility. But we're going to use to a large extent, we're going to look at average implied volatilities today. But basically what that's saying is over the next year, the one standard deviation move on this, or about a 68% chance, is just probabilities, not a guarantee of anything, that this is going to go up or down one standard deviation about 27%. That's how to interpret those IV moves. Furthermore, if you're interested in going, well, what about in terms of a day move? Divide it by 16. It's called the rule of 16. If I took 27 and divided it by 16, the expectation is about 1.6% or so move on a daily basis, up or down. We don't know. That's maybe a little bit high for implied volatility for this stock, but we got earnings coming up too. We got a lot of earnings kind of coming up here. And you can see kind of where implied volatility is compared to where it's been in the past. So here it is right now, average implied volatility, remember that, compared to, it's charted out over the past year here, because I have a year chart on this, and you can see it was at one point it was very high, and for most of the year it was actually a little bit lower than that. There's other places to look at implied volatility here, and one is if you go to the trade tab and you pull up the stock and go down, not the trade tab, the trade tab, and scroll down under the options, you'll see today's option statistics. And you'll see, oh, what's the high implied volatility been this year? About 41%. What's the low implied volatility been over the past 52 weeks? There we go. And what the current level is, about 27%. Where does that put it? Well, that puts us in a range, okay? And that range is what most traders would traditionally call an IV rank, implied volatility rank. So it's a little less than midway there. It's less than half if you look at this scale. And you can see that, by the way, if you go over here, there's a script called IV percentile. It's not a custom script. It's just available to all of you. If you guys want to pull that up, we're going to talk about some customizations today on this, but not yet. Right now, if I click on customize, there's one called IV percentile, okay? And that's going to show you essentially this number. So if I pull up, let me sort this for CL. I think that should be, there we go. 41 is just rounding up to 42%. This number is the same as that number. Okay, easy enough. Now, here's the thing though. When we look at this percentage and we say, well, it's right here, and you go, well, that's kind of actually lower than mid-range. We said 42%. And you look at this and you go, well, actually, if I were to draw a line, and I'm not going to be very good at drawing this line here, so forgive my imprecisely drawn line here. Okay? If this is where we currently are, and we say, oh, 42% is less than half, and you look at this and you go, wait a second, most of the year it's been lower than this. Why would it be showing such a low number here? Well, the answer is this. This is looking at the range between the very high and the very low. It's not looking at the time spent there. Okay, so this is truly like an IV rank is what we call this. But most of the year, this is relatively high compared to where it is most of the year. And so there's another measure that we can use, which would traditionally be called an IV percentile. It gets kind of confusing because of the terminology, because this is already called IV percentile here on Thinkorswim. And there's another number that we can use that I'm going to add to our chart, and I'll share the script with you as well, that's going to give us a different look at this. Okay? So on here, I'm going to go up to my studies, and I'm going to put in, and I've titled it a big clunky name that you may want to change the name of, but I'm going to apply that, and here's the number. this is an IV, this is what we call an IV percentile, not to be confused with this IV percentile. Notice the difference. Colgate 42% is the measure over here. This one's showing 88%. What are they telling us differently on these? This IV percentile is saying what percentage of the year has this implied volatility been below this level? I won't draw the whole thing again. But, well, the vast majority of the year, in fact, 88% of the year, implied volatilities have been low. So I ask you, is implied volatility low right now, or is it high on Colgate? If I look at this measure, it's actually fairly high. If I look at this measure, it's kind of more on the low side of things. What gives? What do we do? Well, the answer is they're both right in a way. The range, this is saying where it is compared to the overall range, but not where we usually are. It's kind of like a difference between sometimes like in statistics, you talk about means and medians, how there's a difference there because of a few outliers or something like that. Well, that's what we have here. I would say for a lot of traders, this may be perhaps the more pertinent issue. Now, don't confuse this number with what the implied volatility is. The implied volatility, the average implied volatility is 27%. So when I was talking about annualizing that move, this is the number I was referring to. When I was talking about looking at the average daily move, this is the number I was referring to. But when I talk about whether this move is high or low compared to where it's been over the past year, these are the numbers that we're going to be looking at. And I'm probably going to focus more on this one today because I think personally it's probably a little better look. They both give you information, but this is maybe more important in my mind here. I don't know. You can make up your own mind on that. Now, then I thought, and this script, by the way, was shared by Christopher A. Okay, I appreciate Christopher for sharing that with me and giving me permission to share it because I think it's a valuable script. Now, here's the thing. I took that script that he sent me and I converted it into also let me just kind of shrink this down here. I also converted it into a script, a watch list script right over here, okay? And so now what I can see, we'll let this load here. Okay, Chris, thank you very much. And I converted it to here so we can view it on a table. Now I have 100 stocks and it's converting a lot of data, so it's just taking a sec, and my computer's taking a sec to do this. But now what we can see when we look at Colgate, it says it's still loading, but once it loads, it comes up and it will show essentially the same number here. Okay, we'll give this a minute here. And so I don't know which is the better format for you, whether you want to view it on the chart or in this. I think sometimes it's nice to have it in the watch list because then you can sort the watch list, right? You can sort that watch list. In fact, let me sort here. I'll sort it a couple times. Now, I will share this with you. I'll share both of these with you. I titled this IV percentile, and I just put a couple asterisks next to it. In reality, what should probably say is this one, but I have no control over this one because this is the preset one. This one really should say IV rank, okay? So you can name them whatever you want though. All right, so let's share the scripts with you. I'll share them in the chat, and then I'll share them in the chat, and then what I will do is I will put them I'll put them down here. I'm hoping I don't restart the whole process of loading there, but we'll see. But by the way, in terms of how quickly these load, it's helpful if you don't use such a big watch list or you don't have multiple columns of data. I have 3 columns of data there right now that is trying to compute. Okay, but let's go to the scripts. Okay, as for this script on the chart, we're gonna share this guy here. And I titled it IV percentile time below current, just to distinguish it from other things. But fair enough, you can title it whatever you want. And I just clicked on the wrong thing. Let's go here. Let's share IV percentile. Okay, this is chart. Okay, share. We're going to click on that. And I'm going to put this in the chat first of all. And just a reminder that scripts are not guaranteed for timing or accuracy. Okay? They're not guaranteed for timing or accuracy. So that's that script right there. And once you name it, okay, once you name it, then once you import it, so you take you take that code I put in the chat, you go up to the little far gear on the far upper right, go to open shared item, paste it in here, and once you paste it in here and click on preview, I think it'll give you the choice to name it, to rename it down there, and then you can import, okay? And that way you can find it in your stuff. Now, what about this one over here? Well, let's do the same thing over here. And I fear I may have reset the whole thing here doing it restarting the process. But let me go to customize. This one, let me share this. And all I did, I just took the script that Christopher did and I just took out like one little thing on this to make it a little bit to look a little different right there. That's all I did on this. But what I'm going to do is I'm going to share this one and IV percentile, and we'll say watch list. Let me share that one. And I'm going to put that in the chat as well. Control V. Okay. So there we go. Now, for those of you who are interested in these that are watching on a recording, what I will do is I will put them both right down here. Again, probably resetting the script. Control C, I'll put them in order on here. The first one, okay, why is this not copying and pasting for me? I'm going to try this again. Control C. Oh, I'm typing in the wrong area, that's why. Okay, and there's that. Now, let me just see if I can make that a little bigger for you. So the first one is the one on the chart, and the second one is the column script for the watch list. Okay, there's those. And really, when you copy it, when you type them in, you just need to do from the exclamation point on. Okay, and they are case sensitive, by the way. So there you go. Okay, we'll move forward here. Now, let me go and let's pull this up here again. And so here you go. You can see it's loaded. And sometimes there's a pretty big differential between them. Look at Honeywell here. Let me pull up Honeywell. And I've got, is IV high or low? Okay. Using the traditional IV percentile, you'd say IV is pretty low on this compared to where it normally is. But if right here, you can see most of the year, it's actually spent below that. So why do we care? Well, one reason we care is if you're a stock trader, you may want to know what's the expectation for the move on this? Am I buying a stock or trading a stock that is likely to move a lot or just a little? Okay. And often what I'll say is, hey, don't just look at what the implied volatility is. Look at the implied volatility where it is as compared to where it has been. And you can see visually kind of where it's here. But if you wanted, let's say you want to search for a stock that maybe has an IV percentile that's a little bit on the higher end of things. Ooh, let me click right here. Here's our IV percentile. It's pretty high. Well, we've got earnings coming up. Probably not a shocker that IV percentile is very high given that earnings, and I'm just going to focus on our new number here, this IV percentile number. Probably not a surprise that we have that with earnings coming up because implied volatilities tend to be high right before earnings, right? So there's that, okay? So we can look at another one. Here's Amazon. Amazon, quite high, even though we actually had earnings last night. It's still very high compared to where it's been. Surprised it hasn't dropped more at this point. Wait. Amazon, that's today? No, Amazon's after earnings today. That's why it's so high. I was thinking it was yesterday. No, Amazon is today. And that is why options are more expensive. This, by the way, if you're kind of like spacing it and forgetting that there's earnings coming up, this can be a reminder that if you see a super high implied volatility, it's not a guarantee earnings are coming up, but that could be one indication. I've caught myself more than once on that, looking at implied volatilities being high and seeing and going, oh, I better check earnings here on this. Okay, now, so let's switch to from the options perspective. Okay, why do options traders care? Well, number one, they want to see what the movement of the stock is. But number two, options buyers prefer when implied volatilities are going to go up. Okay, you buy a call, it's better for the call if implied volatilities go up, everything else being equal. If you buy a put, yes, you want the stock to go down, but you want implied volatilities to go up. It benefits the trade. Number two, it's just the opposite with option sellers. If you sell an option and you see a implied volatility that you think is going to go down, then that tends to benefit you because you're selling it up front for more money and presumably you can buy it back later for less, everything else being equal, okay? Implied volatilities would tend to help option sellers. So that's the difference between options buyers and option sellers. Now, notice I emphasized it's not just what the number is, it's what you think, where you think it's going to go. Well, one possible factor in terms of where you think it's going to go may be looking at it and going, hey, look, if most of the time it's up if it's down at a lower level and I'm looking at it and it's up higher, maybe my expectation, and I'm going to forget earnings for a sec, my expectation is maybe it's going to go back to revert to more of a mean, revert to an average, more of an average level. Okay, so that's the theory. Likewise, similarly, if you go and you find an IV percentile that's particularly low, let's try General Motors, and you go, well, it's only lower than where it is right now, 18% of the time, there's probably an assumption, a common assumption that is a reasonable assumption, but not a guarantee by any means, but a reasonable assumption that if implied volatilities are much lower than they traditionally are, then they may go up. So you can use this script, or you can use the one on the chart, either way, to try and help you identify potential option trades, whether you're looking from a buyer's standpoint or a seller's standpoint. So if we're going to start off, and I'm looking at these and I'm going, well, here's my implied volatilities. Let me just kind of sort these alphabetically here. And I'm looking and I see my implied volatilities on Intel are, what are they? The 75th percentile. So 75% of the time it's below here. Maybe we look to do a selling transaction. Now, there's still a lot of companies coming out with earnings. I'm going to avoid earnings here. Now, one way we can avoid earnings is you can always look at the chart right here. You can go to the Analyze tab, Earnings Earnings sub-tab, and look for the earnings date there. You can go to the earnings calendar and see what's coming up. Or here's another script. okay? And I'll share this one to you in just a little bit here. But this is a days until earnings script here, okay? So if I go days until earnings, and I go down here, and I can see Apple and Amazon, we just mentioned today, after the market closed today. Gilead, after market closed today. Apple. And I want to deliberately avoid earnings. I may avoid these that have earnings in the next 10 days here. You can see those right here, okay? Or actually more than 10 days. It looks to 19, it looks like the next 20 days maybe is what the lookout period is. And if it doesn't have anything, it's indicating it's beyond the 20-day mark here. Okay, so let me go to Intel, and the expectation given our IV percentile script is implied volatilities may decline. Again, no guarantee. That's fairly typical after earnings. Maybe they decline. Of course, there's other factors that can affect these things. If geopolitical events or economic events, the whole market moves a lot, this can spike. A lot of companies had this spike in implied volatilities that really weren't necessarily, I mean, we did have earnings here, but this was probably as much related to just the overall market kind of crashing as anything. All right. Now, question in the chat, Iron Condor, what would we want it to be? Well, let's think about it. We said buying strategies, generally we'd like, if possible, implied volatilities to be lower and going up. Selling strategies, if we'd like them to be going high, you sell it for more, but going down. Using this script can help identify that for us. Because think about an Iron Condor. An Iron Condor is you're doing a short call vertical and a short put vertical. Now, I don't want to get too much in the weeds here on this, but these are both selling strategies. What we'd like, therefore, would be to see a higher IV percentile if you're sorting for this. Now, there's other factors, right? When you're talking about an options trade, implied volatilities are one factor. They're not everything, though. If you're doing an Iron Condor, I want the stock to go kind of sideways, right? It's more of a neutral type trade. And if you're interested in learning more about Iron Condors, a shameless plug here, I teach a webcast on Fridays called Condors, Calendars, and Butterflies at 2 o'clock Eastern Time, where I frequently talk about Iron Condors in there. You can go through the playlist on that and find some Iron Condor stuff. But to answer your question directly, we'd like to see that higher implied volatility percentile. In this case, we have a higher implied volatility percentile, no earnings coming up because it's blank. And look, we got earnings in like 3 months. And so maybe we'll look to do a trade. If I'm a trend trader, I may go, hey, look, the trend is going up. I'm just going to assume the trend is going to continue up. It's an assumption. It may be wrong. But what I'd like to do is I'd like to be able to sell this. I will share that days until the earnings script as well. Yes, I will, Paul. Okay, so thank you. Let me just kind of continue on with this thought here. So my assumption is this stock is going up. It's trending up. And implied volatility is going to go down. So if I'm going to sell something, maybe I'm selling a put here on this. Let me just look real quick. Current IV percentile, looking at the traditional IV percentile, it would be kind of actually low right now if you were trying to sort by that. So I think this is actually a superior way to kind of look at this. So before I share that, I'm not going to forget to share the days until earnings script, but let's say we're going to sell a put here. And we're going to say, hey, I'm bullish on this. I'm going to sell that put out of the money. Let me just get rid of this column here. And we'll go to something lower delta. We'll go to like a 26 delta maybe. What would that give us over 2% on this? A 37.50 put. What that's saying is, I'm agreeing to buy the stock at 37.50. I'm going to draw a line right around what 37.50 would be there. I'm agreeing to buy the stock there. Well, if I'm bullish on Intel and I think it's going to go up, if we dip, we're buying at a lower price. If it doesn't go down, we're not going to buy it, but I'm getting paid $91. That's at the bid. We may be able to get a little more than that, which represents more than a 2% return over the next 22 days on that. Okay. So I'm going to sell that. And by the way, here's another place where you can see implied volatilities listed. That's kind of an average implied volatility for the November 21st expiration right there. And if I wanted to sell that, I would just click on this, double check your quantity. You want to be sure, because if you're selling a put, you're obligating yourself to buy 100 shares of stock. Well, 100 shares of Intel at $37.50 is going to be $3,750. $3,750, yes. So, that's an obligation you just got to be aware of there on that. I'm going to confirm and send, and I'm going to send. And just a reminder, anytime we do a short option, short options can be assigned early. Okay, now let's go back. We'll look for another trade here in just a minute, but let me share that days until earnings script here. And this was originally created by a colleague of mine, Ken Rose. Okay, so that was his script, just getting credit where it is due there. And Ken is, last I've heard, enjoying a very happy retirement at this point, but he was very good at ThinkScript, and I appreciate on him for that. So this is days until earnings. Do this and do this and put that in the chat. Same thing applies on this one as the other one. Scripts are not guaranteed for accuracy or timing on that. Let me shrink this down. That will be, for those of you watching on recording, it's the third one on the list. So exclamation point, SWPZUFUA. It is case sensitive on those. Yes, Will, you're right. Ken is an awesome guy, brilliant photographer as well, by the way. And for those of you who have followed him on X. Let's go and just talk about the other end of the spectrum here. Okay, so that's a selling strategy, and we can do other selling strategies here, but we have a little time. Let me go back. Remember, if we're looking for options, maybe we look here at this and we kind of try and find something that maybe is a lower implied volatility. A lower implied volatility, GM, in this case. Implied volatility right now is about 31%. And you can see visually, looking down here, it's, well, definitely on the low end, probably any way you cut it, not just in terms of the IV rank, but the IV percentile. But it is, it's easy to identify them this way, isn't it? By just using the call. You don't need to use a scan or anything. You can do this. Now, this doesn't tell me whether it's going up or down, but if I'm going, well, that has been my technical analysis says I'm bullish on this. Maybe you're throwing on a moving average. Let's do a 20-day. How about moving average here? Here's my 20-day, going up, gapped up, presumably some support here. It's kind of flagging right now. Now, I don't know. Some people may wait. Some traders would say, well, I want to see some confirmation that this indeed is going to be a flag and a breakout. And say, I only want to get in if we go above this line. Okay? Well, you can do that if you want. We can hold off on that. But if we're going to go bullish, maybe we do something that would benefit from an increase in implied volatility, because implied volatility, let's be honest, is pretty low right now. How would it increase? Let's look at it. Let me go out a little bit farther in time. We'll go out 50 days here on this. And I'm just going to look at long calls on this. And I'm going to go more or less, we'll go just a smidge out of the money on this. So let's go and let's look at Theo price. And I'm just going to reset this Theo price. And let's look at the chart and say, what if implied volatility were to go from an average of 31 up to, I don't know, 36 or so here? What impact is that going to have on the trade? Now, the stock may go up, which is going to impact a long option. Time will pass, which can impact an option. But if we were just solely looking at the impact of implied volatility, if I go and say implied volatility is going to go up 5%, and of course this is just a guess, I don't know what implied volatility is going to go, but I do know right now it's pretty low compared to where it's been. And I look at that, and I look at what strike we were saying. We're saying the 70 strike, that's taking it from about a 272 mid price up to about 320. So that's well over a 10%, better part of a 20% gain on the long option, purely on implied volatility moves, okay? And so that's why implied volatility could matter for you. Now, of course, that nice gain in implied volatility isn't going to do us any good if the stock goes down $5, or you pick the amount here. If the stock goes down enough, it's going to wipe out any volatility gains there on that. So that's how we could do that trade if we wanted to. And if I wanted to enter it, I could just say, I want to go here and I want to enter it. If I wanted to say, I only want to get in if we break above the $70 level, I'm waiting for this stock to go up to give me that flag breakout. Could I do that? Yeah, I could do that. I could go here and I could say, I'm going to make a market order. I'm going to make it a good till canceled order. I'm going to click on the gear, pops up in a different screen, and I'm going to say if GM marks greater than or equal to $70, or $70, then and only then am I going to enter that trade there. Okay? So, and I'm just going to do one contract on there. Just remember your risks on each of these trades. Obviously, it's not going to buy quite yet, even though the market's open, because where are we at? We're below 70 there on that. All right. Now, that's what I wanted to cover today. Let's just kind of review it, and then we'll send you on your way. There are different ways of measuring the implied volatility, okay? I've shown you a bunch of them. One is just to pull up implied volatility down here. One is to look at the IV percentile, but we talked about some of the perhaps inadequacies of that. One is to use this nice new chart script that Chris shared with us, which can be used as a watch list script, a column script as well. I shared all those scripts with you, and combining this script with our days till expiration script enabled us to look for either long options, which we gave you an example of, or short options that are avoiding earnings. Now, you don't have to avoid earnings, but just for our purposes right now, I think a lot of you want to take that extra variable out of earnings and want to avoid earnings here. So there's a variety of trades there. Let me just mention this, one last thing here. The types of trades I mentioned that would tend to benefit from a lower implied volatility that you think is going to go up would be long options trades, like a long call or a long put. A calendar spread would benefit from that going up. Often debit verticals may do that. Options trades that would benefit if You think implied volatility is going to go down? Short trades, short options, short call verticals that are out of the money, short put verticals that are out of the money would benefit from there. Iron condors would benefit from that. Butterflies would benefit from that. So there you go, folks. Hope you find that helpful. Those are some great to have you here. I'm really, I think that was I really, there's only so much room you have for scripts in this Kate column scripts area. I'm hoping that someday they increase that, but I had to boot out an older script that I don't even use much to add this one in there, but I think it's valuable enough that I think it was worth it. So remember, scripts aren't guaranteed for accuracy or timing. And Kevin, thank you for helping me out in the chat, of course. And coming up next, we got selecting an option strategy. So everybody, have a wonderful rest of the day, and we'll see you all same time next week. Bye-bye, everybody.